Okay. Welcome. Aaron Adams here. Aaron Adams Training, Alpine Capital Solutions. I have a good friend and a couple of guests with me today. Many of you know Jed Rammell, my business partner on all things Idaho. He is here today. And Daniel Packard, some of you who were with us on Tax Bracket Pros, you may remember him. He is partner in the firm Cooper Norman, which is biggest firm in Idaho. Would that be correct in saying?
It would be correct, yes.
So biggest collection of CPAs doing the largest percentage of probably net income, business income of tax returns. Dan is the resident genius and is someone that we've used. And I wanted to just take about a half an hour today and introduce a topic that even the savviest investors have heard of, which is cost segregation, but have really not taken advantage of it. Are not utilizing. And, you know, Dan, that was one of the biggest benefits that came out of the new Trump tax laws, right?
Yeah, so clarification around leasehold improvements, certain improvements that people make to real property. It was clarification that we've been waiting for 3 years. So it's definitely something we're glad to have seen. And I think many real estate professionals or those that actually invest in real estate, it needs to be an integral part of their tax planning for 2020.
So, you know, maybe we can use our new building that we built in Indianapolis as a rough example, and then also talk about it in the context of trailer parks, because those are something we've done a lot of lately, and some of our partners on those are really excited. So we built a new building in Indianapolis, a new building for our offices, and we did it cash, and we spent just over $800,000 on that building. And, you know, if we were to do just the old school straight line depreciation on that, assuming the lot's only worth about $50,000, we would have done what, Dan? Take $750,000 and divide it by how much?
39. So yeah, you're looking at about $19,000 a year in depreciation on that.
So what that means from a K through 12 standpoint is every year my partners and I we'd be able to split 3 ways that $19,000. Or if we have profits in the company in Alpine, we can use that as a write-off first. In the case of Alpine, we distribute all the profits to the partners, and so then each of us would get a write-off. Am I saying that right, Dan?
You are, yeah. So you alluded to some of your intelligence in the realm of real estate here, Aaron, that I'm gonna probably try to dumb down a little bit, if that's okay. You said $800,000 for the purchase price. You subtracted out $50,000 for land. The reason being is that land is non-depreciable.
Right.
And so what you were doing is saying, okay, I have this new facility. It's $750,000. You paid cash for it, huge cash outlay. How do you translate that into a tax benefit for you? Tax law right now is, I'm not going to say punitive, but it certainly is very conservative when it comes to real estate and how quickly individuals can take that $750,000 investment that they made and recoup it from a tax perspective or use it to reduce their taxable income. Commercial properties, 39-year properties, and your residential real estates are 27.5-year properties, which means in your specific instance, Aaron, you paid $800K, you get $19,000 for the foreseeable future of a write-off. And that's a pretty slow burn when it comes to benefit.
Yeah, it's almost like, you know, we thought we were being conservative and we paid cash, but the reality is it makes me think, well, maybe we should have got a mortgage if we're looking at 39 years to depreciate. $19K a year over the next 40 years is not something to really get excited about. And so in talking to you, though, you said, hey, how much did you use? You know, because we did a huge AV system. We put in screens and TVs and Wi-Fi and routers, and we spent about $150,000 on the electronics to do classroom and presentations. How would that be treated under cost segregation? This is where cost segregation gets really sexy, and that's not a word that CPAs get to use a lot, right?
Yeah, you're going to find that most CPAs are not utilizing cost segregation to the benefit of their clients, and it's just because it's involved. It requires licensed, trained professionals to make the determination of how to segregate that value. But really, the operation of a cost segregation is exactly what it sounds like. We take that building and we segregate it or break it into its component parts, identifying things that we can depreciate faster than 39 years. So you alluded to a few of those things: specialty electrical equipment, appliances, Other ones that people don't really think about are wall coverings, cabinetry, your millwork, your floor coverings, specialty plumbing, carpeting, accent lighting, electrical systems. There's a lot of things that you can break down into faster class lives for depreciation purposes. And again, as you've mentioned, that's been further amplified by recent tax reform as it relates to the 15-year class life.
So for example, in the case of the electronics, could I write all 150K off this year?
You could. Yeah. So what's really cool is that anything that's in a 5, 7, 10, 15, all the way up to a 20-year class life, tax law presently allows you to write off all of that in the very first year. So leasehold improvements that used to be 15-year write-offs now can be written off entirely in the first year.
It's just massive. And when you explained that to me, it just blew my mind. I mean, let me flip it. So obviously we can't depreciate the land. What would, in that building, what would we have to depreciate over 39 years? What are we just stuck with slow burn on the write-offs?
Structure, really,
Foundation.
and yeah, I mean, structure, the basic components of that building. Now, don't get me wrong, there's a lot of value in those basic components, but a conservative cost segregation is going to put about 30% of your value into a cost segregated vehicle. So let's take the 750 you just said. Conservatively, we're going to find $250,000 of a write-off in year one.
Huge, instead of $19,000. And
that's right.
That's what people don't understand is that if you find a cost seg specialist to help you set this up and walk through this, you'll never go back to the traditional depreciation way of writing things off. It's just so much better to break down the individual parts of that house or of that building and then write them off separately.
Yeah. One of my favorite things to do is because I have a lot of clients that say, hey, I don't want the benefit just in year one. I want big lumps of benefit for the next 5 to 7 years. What we'll do is we'll do a cost segregation, put assets in the 5 and 7 year class life, and write off all of the 15-year assets because we can. And so 15 is the one that we write off in the first year and then forecast out for them, okay, you now have 5 and 7 year assets for the next several years. You're going to get $30,000, $40,000, $50,000 write-offs for the next several years, as opposed to taking the full 250 at once.
Yeah. So imagine my partners and I, under the traditional depreciation, we're only looking at a $19,000 write-off under a good cost segregation analysis that you and I are actually working on right now for Alpine. That could be double, triple, quadruple, and you can almost kind of pre-schedule it, pre-plan it out to get the write-offs in a way that you're getting a drip over the years, correct?
That's correct.
How much does it cost to pay someone with your expertise to do a cost segregation?
That's a good question. It depends a little bit on the structure. On the residential end with Jed, actually, we've built some great efficiencies. Jed has, as you know, a strong real estate background as well. And so we've built some great efficiencies around the cost segregation for your modular homes, for your rental real estate, your residential real estate. Those can be done very efficiently. Your normal cost segregations are going to cost for those types of properties between 5 to 10,000. We're doing it for half that. So we're going to get it done quickly. Really, this just is building off the efficiencies, Aaron, that you've built around your network. So this is something we're not doing for everyone, but something we certainly could do with those that you're plugged into.
Yeah, and so that's where Jed has been working on the accreditation for that. What's that called, Dan?
It's a CAAA LP or something like that. It's a designation that'll go past his business card, unfortunately. The
right.
Length of his business card.
And so we're getting Jed up to speed on that because we want, for Alpine, we want, as our clients, if you're watching this, we probably sent you this video, but we want you to have someone on our team. As many of you know, Jed runs our Idaho operation with me. We're partners in that operation. We have modular homes, we have dealerships, we have mobile home parks, we have apartment complexes that are under the umbrella. And so if you as an Alpine client have received this video and you want someone to help walk you through this, for just a few $1,000s, we can help you put cost seg together, and Jed can be a point of contact to answer questions, liaison with you. Dan's a bigwig, and he's super busy. In fact, he's so busy, you have an office by your house that you go to after your kids go to bed, right?
I do, but you're making me sound like a diva. It's not that nice of an office, Aaron.
I'm on the waiting list. It's like trying to get season tickets to the Patriots or something. No, no, but Dan, you do have some billion-dollar clients. Is that not correct?
We do, and what's cool about these strategies is that even if your taxable income is $100,000 or 200,000, or if you're $1 billion taxpayer, these strategies fit into any model. At the end of the day, the goal is to create a sustainable tax strategy that utilizes everything that case law will let you utilize. I mean, there's too many people that are convinced that cost segregation or these other strategies present risk to their income tax returns, and nothing could be further from the truth.
And Jed, we can get them in for as little as $2,500, right?
Yeah, and I think, Aaron, from a big picture discussion, what we can do is really simplify it where we say, look, we're going to put things into two buckets. There's a real property bucket and a personal property bucket. And once we've made that designation, then we can sit down with Dan and say, okay, now that we've got this into two different buckets, how do we want to structure our tax liabilities going forward? How do we want to control our own earnings going forward?
It's huge. It's huge. Mobile home parks are an interesting creature because really there's very little in a mobile home park that's permanent. I have a mobile home park that's only 8 spaces in Kansas City. And the only thing we own is the dirt, which is not depreciable. We have 8 concrete pads. We have 8 electrical meters to hook up, 8 gas lines to hook up, 8 water, 8 sewer, and an asphalt road that's brand new that we put in. Those are the only fixtures on that park that are more permanent. But then we have 8 manufactured homes that are not on permanent foundations that could be moved again, that have the axle sitting underneath them, that we put in, and we rent those out as rentals. Now, if a client brings you something like that, Dan, why is it now in terms of dollar amount? We spent less than $100,000 for the park itself, and the real spend was on $80,000 on each one of the homes. So we have like $640,000 in homes that we put in there. Only $150,000 in the park itself. When a cost seg expert like you sees something like that, why is it exciting?
Yeah, so historically, your modular homes have been effectively what Jed has called personal property. It's known as 1245 property that allows you to write them off entirely in the very first year. That's supported under Rev Ruling 77-291. It was, some case law that was built around a taxpayer that was taking this position. Now, the realm of real estate develops a lot faster than tax law does. And so there's been new interpretations stating, okay, well, hold on, even these modular homes, is there an aspect of it that's actually real property as opposed to personal property? The long and short of it is that whether you take a position from a tax perspective that it's all personal property, all 1245 property, or that it is real estate as well, your point is well made, Aaron, that contains a lot of personal property, a lot of 1245 property that you can write off. I gave you the example on your commercial property that you'd be able to do about 30%. That doubles when you're talking about modular homes, 50 to 75% on cost segregation into an accelerated model. And that's still a conservative position because you're kind of disregarding your ability to write off all of it. You're saying, I'll take a more conservative approach and write off just most of it.
Jed, we had looked at trying to find loans for our clients on those mobile and manufactured homes. And what kind of loan, what they call them chattel loans, right?
Correct, because the lenders, even though they'll tell you they're treating them as a traditional mortgage, you're looking at a 12 to 16% annual interest rate because they're treating it closer to personal property.
And when you look at a manufactured home, how it's deeded or titled, it's usually not at the recorder's office. In most states, we see it down at the DMV. And
Correct.
It's a deed more like what you would see on an RV than a title that you would traditionally see for a home. And so, because of some of those scenarios, mobile home parks have a huge opportunity, like Dan said, to where you could write off 50, 60, 75% of that in the first few years if that's something you're interested in. Now, Sometimes when I mention depreciation, or when in the case of cost segregation, Dan, an investor will raise their hand and say, yeah, but you got to pay it back when you sell it. And why are they missing the boat on that? Why is that a stupid way to think of it? Why would you, I've had people say, well, if I'm going to sell in a year or two, I don't want to take any depreciation. I don't want to do any cost segregation.
Yeah, well, some of this goes back to just kind of basic investment methodology, where you just state that $1 today is worth more than $1 5 years from now. So in other words, I would take a tax savings today every single time, rather than even at the consequence of having to pay that back in the future, because that dollar today can be used towards future investment, future opportunities, future return on investment. And so conceptually, even at 30,000 feet, even if you're paying back every dime of tax that you save down the road when you subsequently sell this thing, it still conceptually makes sense to do it, because you are accelerating those tax benefits, accelerating that available cash, making that cash available for investment. Beyond that, though, within the realm of like-kind exchanges and 1031s, you will oftentimes find opportunities to defer that tax almost indefinitely. In some instances, some people are making it part of their lifetime marital estate, where they'll have a piece of property that they'll sell and roll into a new property in perpetuity, till they eventually do sell the property, until eventually it's part of their inheritable estate by their heirs.
Yeah, so a couple of really great points you made in there. So, I always think of it from my standpoint. If I can take 100,000 in depreciation this year, I'm paying 40% taxes on every dollar that I can't write off. So if I get 100 grand in write-offs, that's $40,000 I don't have to send the IRS. So the next question in my mind as an investor is, well, what can I make on my money? And I'm very good at making 45% active income, active investing on my money. And so if I don't take the write-off this year, that's 40,000 that ends up at the IRS. And then that's $16,000 in profits that I'm not able to make because I'm trying to be ultra conservative and I don't want to pay back the depreciation. And then that magnifies times hundreds of thousands of dollars in write-offs that I'm able to take as an investor. So the other question that we get, Dan, because I do want to circle back on 1031 because it's such a powerful strategy, is this whole idea of full-time real estate professionals and passive investors. But even a passive investor could benefit from cost segregation. Why?
If they have other sources of passive income, oftentimes your investor pool are individuals that have other investments that they've made that they're categorized as passive within. So these losses that they're generating in this new property that they have can be used to offset other sources of passive income that they have. Additionally, there's kind of that middle of the road law where they say, okay, you're still passive, but you're kind of materially participating. They don't say actively participating, but materially participating. You can take up to a $25,000 annual loss from your real estate as well. So even in that instance, it's yielding you a benefit.
Yeah, it's huge. We have a client who's a doctor, makes over $1 million a year at his medical practice. He's always paying 40% on that. But then he's got a lot of investments that are bringing in a couple $100,000 a year in passive income. And that cost segregation allows him to pay essentially nothing on his passive income. He's paying a low single-digit tax rate on that money. And so he's obsessed about that, and he loves that those tax benefits all stay there. So I find that new investors or many passive investors really neglect what a powerful tool tax benefits are. I mean, my wife and I only made, not only, but we made about $100,000 a month from our passive rental investments. However, we've taken several $1 million in write-offs a year. And so for us as investors who are active and passive, write-offs are a much bigger benefit for me than the passive income that I currently have in terms of my overall net worth.
It's worth way more than just considering the property and what it generates. It's the bigger question of what is it doing to my overall tax picture.
Yes. And you were going to say something else, Dan.
I was just going to say that I find great benefit in looking at an individual's income tax return, because this will oftentimes initiate other questions that we have about other investments that they have as well. This doesn't need to be a closed loop conversation about the property and whether or not they're passive or active in that one property. You widen it out and say, well, let's talk about, Aaron, your other investments that you have. Is there opportunity to recategorize what you've historically called active as passive and use that to offset against this cost segregation that we've just done. So the conversation can widen dramatically as well, is really what I'm saying.
Yeah, and now let's just be candid, because every time I introduce you to investors, they say, "Yeah, I want Dan to be my CPA." If we have a business owner or an active investor that's watching this, at what business income level can you really help them? Like, do you want their business to do 100K a year, 200K a year? Where would you personally consider taking someone on as a client?
Yeah, and this isn't so much, I only work with people of a certain net worth. I want to make sure that when people are paying me for my advisement, that it's effective, that it's a net positive experience. So I don't want to advise people that I cannot make a material, improvement to, or have some material impact on. And so generally that's going to be individuals that are over, or either within or over the 22% tax bracket. We're talking taxable income of right around 160 if they're married. Okay, so if they're in that realm, a drop from that 22% bracket down to the 12, that 10% drop is a huge drop. I can be
Yeah.
effective there. But really, Aaron, if there's individuals or listening now that have $400,000, $500,000, $600,000 of taxable income, and cost segregation is not part of their strategy, they're missing out.
It's huge. Yeah. And so if you're paying over 22%, if you're making 160 plus a year for your business, for your income, and you're paying too much in taxes, you're a business owner, then Dan can really help you minimize that tax bill and really kind of look at what you have, and he'd be happy to do that as well. If you're just interested in getting help with cost segregation, that's where Jed can kind of run interference, do the initial analysis with you at no cost, and then if it makes sense to go forward, then Jed's happy to help. You mentioned,
Yeah, and
go ahead.
Aaron, I'll just jump in and say, we talk a lot about mindset. We talk about like a 6-figure mindset, a 7-figure mindset. And so at the very least, I think people should be looking at this saying, am I looking at my taxes with the right mindset? Does my CPA have a mindset that matches mine? Because I think you'll find most successful business owners walk into their CPA's office with kind of a choose your own adventure strategy. And you should have that. And you should have a CPA that allows you to have that, because you should be able to walk into your CPA's office and say, look, I want to accelerate heavily these first 3 years. Help me craft a strategy to do that. You shouldn't walk into your CPA office and they say, here's what we're going to do. So I think at the very least, it should be a change in mindset for people saying, I need to take charge of my own tax structure, and I need to have a CPA who helps me do that.
Now, let me plug real quick. Dan has agreed to do one of the trainings for Aaron Adams training on tax minimization, tax planning, tax strategies. If you're watching this after November 12th, 2020, then you're going to want to get a hold of that training, because as you can see from this, Dan really knows his stuff, and he has clients that just swear by him for a reason. And that's why he's so busy, and why the firm is so productive. But we're going to be recording in just a few weeks with Dan a full 3-hour training and sit down in a format just like this at our offices in Indy. Dan's actually coming out to help us finish evaluation that he's been helping us with on our Alpine operations, as well as the cost seg for our building. And I said, hey man, if we can get you into Indy just for a couple of days, then let's also record a training, because what you have to say is so valuable. So we're really excited about that. But Dan, before then, you guys are also doing, you were mentioning when we were chatting last week, for the firm, you guys are doing a training as well, right?
We are. So in about a week and a half, we're going to do an hour, maybe hour and a half long, just top tax planning ideas for 2020. In fact, the title of the webinar is Tax Planning During an Apocalypse. So much has happened, in this last 7 months that has changed the tax landscape. We're going to review not only the Trump tax laws that have been in effect for 3 years that people should be utilizing. We're also going to be talking about PPP, EDL, the SBA initiatives. We're going to be talking about payroll tax deferrals. We're going to be talking about everything business owners need to be doing right now to best utilize the incentives and the initiatives that are in place right now. So we're reviewing a lot. Now that's going to be about an hour and a half. We're going to touch lightly on a lot of topics. The one we're doing with you, Aaron's going to be a deeper dive. So I want it to be more of an active conversation. If you have participants there that want to spend more time on specific topics, let's do it. Let's run scenarios. A great one is that You may have clients there that have net operating losses that they've been trying to manage. So much happened in that realm too. So we can run scenarios and say, okay, let's talk about taxpayer Y and pretend they have this and walk people through it so they know what to do.
Love that. So we're going to be posting that Cooper Norman training on Alpine Capital Solutions Facebook page. We're going to be blasting it out to our database as well because we're really excited about that. And then use that as a promo for the Aaron Adams training, full-blown training that we're going to do with Dan in November. So we're recording this September 2020. So if you're receiving it after the fact, feel free to go back and ask us for those 2 trainings. We'd love to get you dialed in on those. Jed, what's the best email for you?
jedwithalpine@gmail.com.
Okay. And Dan, we have your email. Let me pop it up here. No, that's not it.
It's going
What's
to
the
be
best email for you, Dan?
dpackard@coopernorman.com. So DPACKARD@coopernorman.com.
Perfect. Would it make sense to do, if cost segregation costs a couple $1,000, I have a home that I purchased in Indianapolis as a rental. I bought it for like $40,000, but spent $60,000 in improvements on it. It's only worth $100,000. Would that still be worth spending a couple grand on cost seg, or would it start to not pencil at that point?
Yeah, that's a good question. Some of it is dependent on the investment profile of that specific taxpayer. If you're getting 40 to 45% return on your money, Aaron, the truth is there's really no lower limit on for you. I mean, if I can get you $10,000 in additional tax savings, I've already paid for it.
That's $4,000, right? So I brought that up already knowing the answer, because people say to me, well, is cost segregation worth it for single family homes? I think that it is, but it really comes down to 2 things. What are you paying in taxes, and how much can you make on your money? If you don't know those 2 things, the first one's pretty easy to figure out. Dan can help you figure that out in about, but I'm amazed every month, Dan, I meet investors that make 300, 400, 500 grand. I say, well, what tax bracket are you in after write-offs right now? And they're like, I'm not sure. They know how much they paid last year, but that's an important, critical part of coming up with a tax, pre-spend your money, pre-structure yourself, S corps, C corps, LLCs, so that you can maximize all the benefits that are out there. And it's a game, and people need to understand that. Unfortunately, if we wanted to not have a game, we'd just call it a flat tax, and then Dan would be out of business, right? So, but because it's this complicated lobbyist resulted laws that benefit certain businesses over others and benefit certain entities over others, you need a quarterback like Dan and a quarterback like Jed who have the financial background and who can help you figure out for you what the best strategy is. But, Cost Seg is a superstar for mobile home and manufactured homes. It's fantastic for apartment complexes. I've seen websites where they're like, well, if you have a building over 700,000, it's good for you. I disagree. Well, maybe if that company is charging $10,000, it might not be worth it. But at $2,500, it makes even a single family home potentially worth this strategy. And Dan, we have clients that will buy a home from us pre-rehab for 40 grand, and then they fund in the 60K in repairs. And so they're getting write-offs there, but cost seg could just further supersize that and make it that much more interesting, can't it?
Absolutely. I wanted to drive home a point that you touched on here too, as far as trying to legitimize paying for the cost seg. Sure, you're going to have your return on investment and your tax savings as well, but closer analysis of their taxable income for 2020 may indicate that they're about to jump into a new tax bracket, right? And avoidance of that additional tax bracket alone may pay for the cost seg just on that merit alone. Every taxpayer should have the goal of flattening their taxable income. The goal would be, as over 30 years, I'm going to make this average of income, and you want to avoid every peak and valley that you can, because peaks cost you a ton and valleys cost you a ton too, because you are wasting tax deductions on a 12% tax rate. And so really the goal is to say, I want to figure out what on average I can sustain and do everything I can to avoid the peaks and valleys. Cost segs are great ways to help control that.
Now, you mentioned a 1031 exchange earlier, and we do a lot of 1031s. My Becca and Meg, our team, and I would say at any one time, we always have a 1031 that we're putting together for a client. For those of you who haven't heard of a 1031 exchange, let me K through 12 it for you. if you buy a property for $100,000 and you sell it 2 years later for $200,000, you potentially owe 100 grand. You have to pay taxes on $100,000 in gain. And so you can defer that gain and not pay the taxes if you reinvest all $200,000. And so you can't just reinvest the profits. You can't just reinvest what you paid. But if you'll buy another property or group of properties, so you could buy, some land, some houses, a mix of properties that total at least $200,000, then what the IRS says is you don't have to pay on the 100 grand. You can kick that can down the road. And so we have a lot of clients that do that. But imagine then you buy that property, you cost seg it, so you're able to take a huge number of write-offs in the first year, a huge number of write-offs in the second year. Then you 1031 it. You don't owe the payback, do you, Dan, on cost seg or on depreciation if you 1031 exchange a property?
You're finding like property on an ongoing basis, there's always opportunity to defer.
So not only do you not have to pay the capital gains, but you also don't have to pay the recoup on the depreciation. And so 1031 is a gift. In fact, I was on a live stream last night with some investors, and they're freaking out because Biden's plan for it says that he'd like to phase out 1031 exchanges. Whether that happens or not, I think is neither here nor there. First, he's got to get elected. Second, we'd have to see if it makes it through the plan, because there's a lot of high net worth individuals who have high paid lobbyists that would not be happy about phasing out 1031s, would they, Dan?
They would not. The great news, though, is that so long as cost segregations and accelerated depreciation stick around, we can always relatively surrogate the benefit that we'd get from from a 1031. In other words, if we're always buying a new next property and we re-cost segregate, we can generally offset the gain that we create, even on the recapture, with new equipment that you are now writing off.
Okay, so think about what Dan just said there, is that if you have the right cost seg expert in your pocket and you're reinvesting the money, even if you lost 1031 exchange, there's still a way to make sure that you recoup most of the write-offs that you're looking for with that new cost segregation on the new property. And so again, it's something that if it's not part of the tools in your toolkit, and I find that it's in very few investors' toolkit, then this is something that you need to be doing going forward. It's something that I do, something that my partners do, and it's a very important strategy that should be part of your tool belt, your arsenal of things that you're working on. What else should we say about this topic, Dan, that we haven't talked about today?
I feel like we probably covered some strong nuances there. Just bear in mind, the effectiveness is going to change property to property and taxpayer to taxpayer. It's always worth the conversation, though. I'm available to help evaluate the effectiveness of it in each individual taxpayer's, their individual portfolio. So just let me know what I can do to help and be involved.
Jed is jed@alpinecs.com.
Jed with Alpine at gmail.com.
Jed with Alpine at gmail.com. And Dan, your email is?
Packard@coopernorman.com.
And whoever from our team sent you this video, whether it's Megan or Becca or myself, then we can also put you in touch with Jed or with Daniel to move that forward. Guys, appreciate it. This was exactly what we're looking for, a 30-minute-ish overview of this specific topic so that people can get their arms around it and then make decisions going forward. Appreciate both of your time today. Thank you very much.
Thanks.